Assalamu alaikum and hi everyone. Welcome back again to Journey on Learning MFRS 140 Investment Property. Today what we're going to do is we're going to look into details on transfer by showing work examples, starting with transfer from IP to PPE, where we're going to look at the accounting treatment for the transfer from IP to PPE. And then we'll be also moving on looking at later in another video, which is the transfer from PPE to IP. So there will be two videos which is discussing on transfer. So let us look at the summary of the accounting treatment. So our focus is here, the first two. The one here will just be in theory form, right? So we're not going to discuss the transfer from IP to inventories in terms of accounting treatment, as well as transfer from inventories to IP in terms of accounting treatment. But I have provided some notes or summary here to help you with just the theoretical part of the transfers rules for IP to inventory and inventory to IP. Our focus would be from transfer of IP to owner occupied function, which is a PPE. Start with it, which will be in this videos that I will illustrate a few examples on that. And later in another video, we'll be looking at the transfer from owner occupied property to investment property. So that would be the case of having a different MFRS being applied before and after the date of transfer. So the date of transfer is what is very important to decide the change of use, and also when the MFRS will no longer be used. Let's say the MFRS 140 will cease to be used and will be replaced with MFRS 116 PPE. So let us look at transfer into detail now. Transfer to or from, and transfer to or from investment property will take place, or transfer is made when and only when there is a change in use. So on the date of transfer, there will be a change in use, let's say from a rented building that you transfer them to become admin building. So there was a change in use of the building from being rented out to become an admin building. So because of that, this is going to also change the accounting treatment from MFRS 140, and this would be MFRS 116. So there are two focus here that we have. One is the transfer from IP to PPE, which will start when there is a commencement of owner occupation. Commencement of owner occupation, where if let's say IP before this uses CM cost model on subsequent measurement, or maybe use fair value on subsequent measurement, which is the option. So it will now be transferred to PPE. So under PPE, the issue is you will use cost model or the revaluation model. I put here as RM. So the issue is, when does that take place? It would be on the date of transfer. Let's say you have date of transfer here, 1st of January 2020. And the date that you purchased the IP was 1st of January 2018. So this is where it was an IP, and let's say this is cost model IP. So here you are using MFRS 140 but use cost model. But from this date of transfer, 1st of January 2020, there is a change in use, and therefore the IP will no longer be an IP. So it becomes PPE. And the issue is how is, for example, the accounting treatment as at 31st of December 2020. So here, if the company adopt PPE, also cost model, yeah. So here you will also apply cost model that is for PPE, and cost model here is for IP. However, remember, cost model under IP is the same rules as per cost model under PPE. So on the other hand, you may also have a case at the end of the owner occupation where you have a reclassification or the transfer in terms of the asset is being relocated from property, plant and equipment to be an investment property. So the same case here. Here is the transfer that it will not use MFRS 116 from the date of transfer, but will start using MFRS 140 requirement. And again, cost model or revaluation model is also the issue here. And for the IP, whether after the date of transfer, that would be using cost model or the fair value model. This will be covered in the following videos. So let us look at the measurement of transfer, and our focus, as I mentioned, is the transfer from the first one, which is from the investment property, rented building, or maybe a capital appreciation, the land that was held for capital appreciation, that is now transferred to become an owner occupied property, OOP, which is the terms used under MFRS 140, but with a reference to the accounting treatment under MFRS 116. So owner-occupied property will be accounted for as per MFRS 116. So let's look at the investment property. It will be treated as property, plant and equipment when, as I mentioned, that is from the date of the transfer, as there was a change in use. So the change in use here would be, let's say, for the IP, it uses cost model. So on the date of transfer, it will be reclassified as owner occupied property. So as we just give example, 1st of January 2020, this is the date of transfer. So on that date, there is a change in use. So from there onwards, up until there is maybe another events that has taken place, the asset will be a PPE. And when it was using cost model, it means that when it was an IP, before being reclassified, it is being carried at cost minus, carrying amount is at cost minus accumulated depreciation less accumulated impairment loss. So this is for the case of cost model for IP. So the deemed carrying amount of the owner occupied property after the date of transfer would be measured at the carrying amount of the investment property. Let's say on the date of transfer, 1st of January 2020, the carrying amount, which is at cost minus accumulated depreciation minus accumulated impairment loss, let's say the carrying amount of the IP is 1 million. So therefore, this 1 million will be the deemed carrying amount when it becomes a PPE. So this will be the deemed carrying amount of PPE. That was according to the FARS 140. Under the fair value model, IP is stated at where the carrying amount of the IP will be at fair value. So fair value means no depreciation, and we are going to take note that the changes in fair value is in the SOPL, either as gain or as loss on change of fair value. So investment will be reclassified on the day of transfer to become the PPE, date of transfer. Let's say again it is 1st of January 2020. 1st of January 2020. Yeah. So the deemed cost of the owner-occupied property will be the carrying amount of the IP. Before this, the carrying amount of the IP was at cost minus accumulated depreciation minus accumulated impairment loss. But now it would be at the fair value. What is important is that you need to know what are the fair value of the IP on the date of transfer, as that would be the carrying amount of the PPE when it is becoming or have the change in use to be an owner occupied property. So the so-called initial cost of the owner occupied property would be the carrying amount of the investment property that was previously measured at fair value. That would be the one only on the date of transfer. That would be on the carrying amount, not the one previously. The difference between the fair value on the date of the transfer, fair value of the IP on the date of transfer, with its previous carrying amount, which was also the fair value. Let's say this is fair value 2 versus fair value 1. The difference will go to the profit or loss as gain or loss on change in fair value. So that was as a result of the changes in fair value under fair value model. Let us look at first example, which is example number 2 on cost model. And that is going to show the illustration of an IP that uses cost model, and when it is a PPE that is also using cost model. So whenever the question remains silent, you will assume that IP also uses cost model, or the PPE also was adopting cost model, unless stated otherwise, like in this question. It uses cost model on the subsequent measurement of IP. So now this cost model on the subsequent measurement means IP was shown at the carrying amount to be cost minus accumulated depreciation minus accumulated impairment loss, if there is any. So you have the information on a company called Lomba, and that company has a date of acquisition 1st of January 20x0, and the cost of the IP is 4 million, and that was an IP because it was stated here for rental purpose. And you have been informed that it uses cost model, but of course on the date of initial recognition, the IP is measured at cost, right? At cost, the initial cost is 4 million. On 1st of January 2000 x2, 1st of January 2000 x2, it is here. So meaning that after 2 years. So remember, the accumulated depreciation will be provided. So here will be provided, here depreciation, here also depreciation. Because the company uses cost model, I put here cost model for IP, right? And then you are informed there was a fair value information there. The fair value is 3.6. Under fair value model, you will take note, but this is under cost model. So just ignore the information. Don't do anything. And later on 1st of January X5, which is here, 1st of January X5, you have the information that the building that was held for rental are now being used as head office. So here is the date of transfer, DOT. Here is where you have the change in use. Change in use is from a rented building to HO building. So therefore, a change from MFRS 140 to become an item under MFRS 116. And the fair value of the building, the fair value here is the fair value of the IP building, on the date of transfer, which is on 1st of January 2000x5, it was 4.2. So remember what I just mentioned in the previous slide, the carrying amount of the PPE would be the deemed carrying amount of the PPE would be measured at the carrying amount or the fair value on the date of transfer, the carrying amount on date of transfer. So you have the information on fair value here. The fair value is 4.2 million, but however, you need to ignore again this information on the fair value. So the measurement of the fair value here would be at carrying amount of IP, which is the reason is because IP uses cost model. So the carrying amount of IP at this point on 1st of January 20x5, you need to find out what is the carrying amount that is taking cost minus accumulated depreciation minus accumulated impairment loss. So that is what you need to do. Let's look at the requirement. You are asked to explain the accounting treatment for the above situation only on 1st of January 2000x5, which is on the date of transfer. So you need to mention on the reclassification and also on the carrying amount. So on the date of transfer, 1st of January 2000x5, the building is being reclassified as an item under MFRS 116 building. Why? Give the reason is because there is a change in use from building that was held being rented out to becoming an owner occupied property. So that is the evidence that there is a change in use. Remember, you can only do the transfer if you can prove there is a change in use. So that was the first part of it. So you need to mention, or you need to take note that the cost of the owner-occupied property as laid down by the standard shall be the deemed carrying amount based on the investment property carrying amount. So the carrying amount of the MFRS 140 of the carrying amount under investment property. So you need to find out what is the carrying amount, that is cost minus accumulated depreciation. So on the date 1st of January 2000 x5, you need to find out what is the depreciation 1st of January. So from the date of acquisition, if you can still recall, date of acquisition is 1st of January x5, 1st of January x0, and the date of transfer is 1st of January x5. So from this, it is actually 5 years. So you were informed earlier on that the expected useful life, I have not written that information, which is also very important. It was 40 years. So you will calculate the depreciation by dividing the cost on the date of acquisition, that was 4 million, with the useful life. So therefore the useful life was 40 years. So the information for accumulated depreciation of property, it is 100,000 times 5 years. So that is 500,000. So on the day of transfer, since it is now a PPE, the accumulated depreciation relating to the IP must be eliminated. So 500,000 must be eliminated because it has been provided earlier, credited to accumulated depreciation. Now you need to go and debit. The investment property also must be derecognized. The amount that was being transferred, the amount of the investment property, the cost or the carrying amount was 4 million. So derecognized or being eliminated. So that will be a decrease, and there is a new asset PPE building due to the transfer, and you can see that the carrying amount is based on the carrying amount on the date of transfer, carrying amount of the IP on the date of transfer. So that was the journal entry, and you are asked to only explain on the date of transfer. However, in the year ending 31st of December 2000 X5, you would see that there would be an accumulated depreciation to be charged for that particular year, not for the investment property, but it will be for the PPE building, not for the investment property. That would happen in year ended 31st of December 2000 X5. So let us look at the next example, example 3, cost model. So under example 3, this is trying to show another cost model application, and what we are going to look is about a company called FAR270. 100,000 or 10 million building has been fully rented out, so it is an IP, and the date of acquisition, it was informed that was being rented out for the past 10 years. So the rental income, which is to be credited to the profit or loss as an other income, is 190,000 per year. It was classified as an IP now, and the cost model was adopted on its measurement subsequent to initial recognition. So it is still using cost model for the IP, and now PPE also use cost model. On the 2nd of January, the company commenced the use of building for its own operation. So this is the date of transfer. The fair value of the investment property on that date, the fair value was given. So but remember, fair value, you need to ignore them, because building is building IP was using cost model. So if you use cost model, the carrying amount is not at fair value, but the carrying amount again at cost minus accumulated depreciation minus accumulated impairment loss. You are asked to explain the accounting treatment upon reclassifying the investment property as owner occupied property on 1st of January, which is on the date of transfer. So this would be quite easy because you are familiar with the first one, right? So let's look at the answer here. Remember, the date of transfer is our issue. So before the date of the transfer, let's say 10 years ago, this was using cost model. I put here CM, and 10 years ago this was an IP. It was only here 1st of January X8 that there is a date of transfer due to the change in use. So you are asked to explain the accounting treatment here. So the reason is because there was a change in use. The deemed carrying value of the building as a PPE will be as an IP, yeah, if you read the question, of the IP building will be the carrying amount of the building at the date of transfer. So because the word here is building, so you will get confused easily. So why not we just make it easier? This is if you read again, the deemed carrying value of the building will be the carrying amount of the building at the date of transfer. So the IP building carrying amount, which is at cost minus accumulated depreciation minus accumulated impairment loss, would be the carrying amount of the building as a PPE on the date of transfer. So this is because the company adopts cost model. As the company adopts cost model, deemed carrying value of IP would be 8 million. Why 8 million? 10 million is the initial cost, and throughout this 10 years you have provided depreciation. And if you read the question, the estimated useful life was 50 years being revised. The building has an estimated not revised, it was when it was being purchased, it has an estimated useful life of 50 years, right? For the 50 years, and you are now in year 10 of using it. So divided by 50, the estimated useful life, times 10 because you have used it for the 10 years. So you will start providing the depreciation for the year ended 31st of December. Here is 31st of December 2000x8. Here only you start provide the depreciation for what? For the PPE building. Right, that was the case. And now that is the difference between the two. The journal entry is also similar to the journal entry here, that you need to only replace that with the correct amount. So let us look at the information here. The building will be transferred. We have done that. So let's go to example 2, where in this we are still using example 2, only that we now be using the fair value model. Just now we were using cost model for the IP. Now it is fair value model. So take note, there is no depreciation, yeah, and there is also no impairment loss here. So the fair value model, the changes in fair value is what goes to the SOPL, and there is no depreciation. So you have 1st of January 2000 x 0, which is your same year end, the same thing, exactly the same like what you have, only that the date of transfer, on the date of transfer you uses fair value model. So it's exactly the same. So what we need to take note is that we need to take note the transfer that took place. So here, if you look, 1st of January 2000 x 0 until 1st of January 2000 x2, there was a change in fair value here. So you need to take into consideration, since here you are using the fair value model, the cost is still the same, which is 4 million. So the cost here will be the carrying amount of 4 million, and you will compare with the fair value on 1st of January 2000 x2, that was 3.61 million. Right. And there was another change in fair value on 1st of January x5, which also happened to be the date of change or the date of transfer, and that was giving the figure of fair value 4.2 million. So the carrying amount will now be the fair value that you have in the first first valuation will now be the carrying amount. So that would be 3.61 million. So these changes, you will see this will result in gain. This will result in also gain. So let's look at the impact that the company now adopted fair value model. So, and on the date of transfer, the fair value was 4.2 on the date of transfer. And this is where there was a change in use from IP to PPE. So let's look at what you have and see what is actually happening after we have done the working. So on 1st of January 2000 x5, the building is classified as a PPE. The reason, because of change in use, and that is to prove that the evidence is that the property that was being rented now becomes owner occupied, which is a head office. On the date of transfer, the deemed cost shall be the fair value of the investment property on the date of transfer. This one, fair value on the date of transfer, will be the cost or the carrying amount of the building as PPE. The difference between the fair value, the first difference of 4.2, which is the difference there was 3.61 and 4 million. That would be shown as 590,000 here, 0.59. That would be uh, your gain on fair value on the first year, which is on the date of, sorry, it will be here actually. Here is 0.59. Let me just correct here the item here, not this one. On the date of transfer, it would be 0.59, right? Because the difference between 4.2 and 3.61 is 0.59, and that gain is the one on the date of transfer, the one on the date of transfer. So this is the one that will be reported. The one as at 1st of January, there was this fair value exercise here that will not be reported because you are asked to explain on 1st of January 2000X5 only. But that must be incorporated in the record, but you do not need to explain that. So the carrying amount is 3.61 based on the most recent fair value. The carrying amount was 4.2. 4.2 is the fair value of the IP, but now will be the carrying amount of the PPE. So the carrying amount is 4.2. Then the journal entry would be, so first is for you to record the reclassification. So eliminate the IP and recognize the PPE with the fair value of IP on the date of transfer. And on the second journal entry is the one that the fair value exercise on 1st of January, and that would be 590,000. 590,000 comes from the difference of 4.2 and 3.61. 4.2 minus 3.61 million. That gives you 590. So we'll stop for these two examples. We'll continue in our next video for example 4, right? Our other example. Thank you for watching. I'll see you when I will see you. We'll see you in my next tutorial video.